Paid-in capital from issuing stock. So the main source of paid-in capital is from issuing or selling stock. The way that stock works is that one share of stock represents one fractional ownership. So if a company issues 100 shares and a particular investor purchases 10, they would have purchased 10 out of the 100 shares, which would make them a 10% owner. Characteristics of stock. So there is a stated amount of authorized shares or shares of stock that a corporation is authorized to issue. Those are called authorized shares. So they are the largest pool. So all the shares are considered authorized shares. Once they are issued, only the shares that are issued are considered issued. But the ones that are issued are considered both issued and authorized. And then finally, the outstanding shares, those are the ones that remain in the hands of stockholders. So if you own a share of stock, that particular stock is outstanding, which means it is also issued and authorized. So the main reason to review these definitions we'll talk about in a little bit is called treasury stock, which is an instance where a corporation has issued stock and then they have decided to purchase it back from the stockholders. So that's the only time that issued shares would no longer be outstanding in the hands of stockholders, is if they had been outstanding and then the corporation purchases them back from the stockholders. When stock is issued or purchased, a corporation might issue a stock certificate. I don't think they do it as paper anymore. It's more just documentation to show ownership, shows the name of the company, the stockholder, the number of shares owned, and then the dollar amount or the par value assigned to each share of stock. This is an example of what a stock certificate might look like. So you can see that this corporation would be Google, and this is what potentially their stock certificate would look like. So they're rights of stockholders, and sometimes this depends on the class of stock. But stockholders, there are certain classes of stockholders that are able to vote. Stockholders get a share in a distribution of earnings to some extent and a share in assets upon liquidation of the corporation. But these rights do vary based on the class of stock. If a corporation only has one class of stock, it's called common stock. It's all the same, and each share has equal rights. If there is another class of stock, you would have common stock and then also preferred stock. So an advantage of preferred stock is that it gets a preference on dividends, meaning there's a greater chance that a preferred stockholder would receive dividends than that of a common stockholder. So if a corporation goes out of business, the preferred stockholders would get their distributions first. And then as a part of kind of a category of preferred stock, there is cumulative preferred stock. And it is a special type of preferred stock that has the right to receive regular dividends, even if they are not paid in previous years. They have the right to receive what we call dividends in arrears. There's a separate account for each class of stock. So remember, if there's only one class of stock for the corporation, then it will just be common stock. But if there are common stock and preferred stock, then those classes of stock are entered separately. So there are separate accounts for those in the chart of accounts. So assume that a corporation issues 5,000 shares of $100 par preferred stock and 50,000 shares of 20 par common stock. So again, when we talked about bonds, we talked about at face value, stated value. Sometimes there was a premium, sometimes there was a discount. That is similar with stock because we are still being impacted by market fluctuations. So this is just a different type of investment. But here in this example, the corporation is issuing the shares at par. So you would debit cash for the total amount received, credit common stock for the par value of the common stock sold, and credit preferred stock for the par value of the preferred stock sold. So the common stock was 5,000 shares at $100 per share, and the preferred stock was 50,000 shares at $20 per share. So calculate those. For common stock, it's going to be 500,000. And for preferred stock, it's 1 million. So the total cash received was 1,500,000. And that's how you would record stock if there was no premium, if it was just sold at par. So like I said, stock is often sold for a price other than its par. And that's what you look, when you're tracking your investments, when you see what are the stock prices of a particular corporation. That's how you hope to have a return, is by purchasing stock at a lower price than when you sell it. So there's going to be price fluctuation in stock all the time just because of the market. So some things that affect that selling price, the market value, are financial condition of the corporation. So how are their finances looking? Investor expectations of the corporation's earning power. So how are investors expecting a corporation to perform? And then just external economic conditions, things that aren't necessarily internal with the corporation, but that are affecting the corporation. So when a stock is sold for a price greater than par, it is considered to be sold at a premium. And so remember, it was that way with a bond too. Typically, stock is not generally sold for less than par value, but it would be sold at a discount if that were the case. So when a stock is issued at a premium, that means that the selling price is greater than the par value. So when stock is issued at a premium, you will debit cash for the amount received, credit either common or preferred stock, whichever class of stock it is, and then the additional amount received in cash, so that excess will be credited, if it's at a premium, will be credited to paid in capital in excess of par. So that is a new account. Sometimes it is abbreviated PICEP. So Caldwell Company issues 2,000 shares of $50 par preferred stock for cash at $55. So $55 is the sales price, $50 is the par. There were 2,000 shares. So you will debit cash for the amount of cash received. So that was cash $55 times 2,000 shares, which is a total of 110,000. Credit preferred stock, and that will be at the par value, which is $50 times 2,000, and that is $100,000. And then the paid in capital in excess of par, that is where you record the difference between the par value and the selling price. So credit paid in capital in excess of par. And that is the additional $10,000.